Very happy morning to all.
Happy morning, sir.
Sir, we are doing model tax convention, interpretation of tax treaties, and also another third chapter is BEPS, base erosion and profit shifting. In that we understood already, sir, model tax convention. That is, one country want to enter into double taxation avoidance agreement with the another country. So, is there any prefixed format for that double taxation avoidance agreement? Yes, there are prefixed format. That's what model tax convention. Three models has been prescribed. One is OECD model, number two is UN model, and number three is US model. The peculiarity of the OECD model is, in that model convention, between developed countries, that means two developed countries are going enter into double taxation avoidance agreement, they will adopt which model? OECD model. Whereas UN model convention is a convention between one developed country and developing country. That means India will enter into UN model convention, and US model, whoever it may be, if you want to enter a DTA with US, then US model will be applicable. This is the one difference between OECD model and UN model. And my dear lovable students, OECD model advocates resident principle. That means you are liable to pay tax to the country in which you are residents. Whereas UN model advocates more emphasis on source principle. That is, the country in which the income came, to that country you are liable to pay the tax. So OECD model emphasizes resident principle, whereas UN model emphasizes. So OECD model is essential model treaty between two developed nations. Fine. This model advocates the resident principles, that is emphasis on the right of state of residents to tax the income. That's what OECD model. Whereas UN model is a compromise between what principle and what principle. However, it gives more weight to what principle as against the resident principle of the what model. UN model is designed to encourage flow of investment from the dash country to dash country. Let the developed country start pump the capital into the developing country, and let the developed country earn income from developing country, and since it is going to pay tax on source country, let them pay tax to the source country, which is developing country. By that way, developing country will also become developed country. This is the ideology of the what model. And US model, this model convention is used by United States while entering into tax treaties with various countries. We all know that, sir, OECD model contains how many chapter? 7 chapter, comprising of how many article? And UN model also contains how many chapter? But comprising of only. And US model comprises of 30 articles. US model comprises of 30 articles. Okay, well, these are the list of articles of OECD model and UN model convention. Chapter number 1 is talking about scope of the convention, which is article number 1 is persons covered. Article number 1? Persons covered. Article number 2 is taxes covered. Article number 2? Taxes covered. Article number 1? Persons covered. Article number 2? Taxes covered. Chapter number 2 is talking about definition. In that, article number 3 is general definition, article number 4 is resident, article number 5 is permanent establishment. Tell me, article number 3 is general definition, article number 4 is resident, article number 5 is permanent establishment. Chapter number 3 is talking about taxation of income. We are having various incomes are there. In that, article number 6 is income from immovable property, income from immovable property. Article number 7 is business profit, article number 7 is Article number 8 is international shipping and air transport, and article number 9 is associated enterprise, article number 10 is dividend, article number 11 is interest, article number 12 is royalty. You are having 12A and 12B, which is there only in the UN model, which is not there in OECD. And article number 13 is talking about capital gain. Article number 14 is only there in the US model, not there in OECD model. Article number 15 is income from employment. Article number 16 is director's fees. Article number 17 is entertainment and sport person. Article number 18 is pension. Article number 19 is government service. Article number 20 is students. And article number 21 is other income. In that, elaborately, no need to study all the article, because ICA picked certain article that we have to do in detail. So this is a list of article which is there in the double taxation. And chapter number 4, taxation of capital. Article number 22 talking about capital. And chapter number 5, methods for elimination of double taxation. We are having two methods, either exemption method or credit method, as per article number 23A and article number 23. And chapter number 6 is special provision. Article number 24 is non-discrimination. Article number 25 is MAP. Article number 26 is exchange of information. Article number 27 is assistance in collection of tax. And article number 28 is members of diplomatic mission and consular posts. And article number 29 is entitlement to benefit. And article number 30 is territorial extension. And the last one, final provision, 31-30, entry into force. And 32-31 talking about the termination, my dear lovable students. So, no need to buy at all this article. This is the format of the convention, model tax convention. In that, ICA themselves selected certain articles for detailed study. One of that is article number 1 is what covered? Persons. Persons covered. Actually, if India and Pakistan is entering into double taxation avoidance agreement, such an agreement is called as Indo-Pak DTAA. Sir, for whom that Indo-Pak DTAA will be applicable? For 3 people, that Indo-Pak DTAA will be applicable. Sir, other than these 3 people, no one can claim the benefit of the double taxation avoidance agreement. Number 1, sir, in order to apply the DTAA, sir, either you should be resident of a contracting state. Resident of a contracting state. India and Pakistan are the contracting state. Contracting state in the sense means the state, the country who are entering into the contract. So either you should be a resident of India, or you should be a resident of Pakistan, or you should be a resident of both India and Pakistan. If you are both resident of India and Pakistan, it is called as dual residency. If you become dual residency, article number 4 is answering how to, sir, remove the tiebreaker. Sir, that's what. For application of treaty, a person has to be resident of one or both of the contracting state. So either you should be a resident in India, or you should be a resident in Pakistan, or you should be a resident in India and Pakistan. Fantastic. That's what resident of the contracting state. Number 2, physically transparent entity. The second person to whom the provisions of DTAA is applicable is the physically transparent entity, which is nothing but income derived by or through a physically transparent entity under the tax law of either contracting state, to be considered to be the income of a resident of a contracting state, to the extent such income is treated for the purpose of taxation by that state as the income of resident of that state. That means we are having an example. We have not understood anything after reading this. So we discuss this example. For example, state A and state B have concluded a treaty identical to model tax convention. India and Pakistan has entered into a double taxation. State A consider that entity established in state B is a company that is opaque. That means there is one entity which has been established in the other country, another state, where the state A is seeing that as a company. That means state A will tax it in the form of company, and the taxes that entity on interest that it received from debtor resident in state A. So from state A, they are getting some income, they are getting some interest. So whether that interest has to be taxed in state A or state B, to whom the DTA will be applicable is the question. Under the domestic law of what B, state B, however, the entity is treated as firm, which is what entity? Transparent entity. It is not opaque. So according to state A, that entity is a company, whereas according to state B, that entity is a firm. That means this is what the separation. The assessee classified into 2 categories. They are company and firm. Company in the eyes of state A, firm in the eyes of state B. Fine, fantastic to the core. Come on. Sir, however, the entity is treated as firm, transparent entity on the and the two members in that entity, two members means two shareholders, two members, two partners, whatever it may be, who share equally all its income are each taxed on the half of the interest. That means in this firm, two partners are there, partner 1, partner 2 or member 1, member 2. Whatever interest they have received from state A is going to be taxed in the hands of these two members at 50% and what? 50%. Fantastic to the core. So, one of the member is a resident of state B. Fine, fantastic. This member is a resident of state B. That means in order to apply the provisions of double taxation avoidance agreement, you should be either the resident of state A or state B or both of the states. That means, sir, this guy is a member of state B, whereas other one is a resident of country with which state A and state B does not have a treaty. That means this guy is a member of state C. With state C, India and state C does not have a double taxation avoidance agreement. Pakistan and state C does not have a double taxation avoidance agreement. Either of the country does not have a double taxation. That means, sir, this 50% is not covered by the provisions of double taxation avoidance agreement. For this 50%, normal income tax provisions will be applicable. And if you paid any tax for that section 91 can be claimed. 91 can be claimed. Relief under section 91 can be. But for this 50%, you have to see either tax exemption method or tax credit method. Either it will be taxable in country A or it will be taxable in country B. As per article number 11, because article number 11 only talking about interest, because this partnership firm has received interest from state A. So, of that state A's income, whether it has to be taxed in state A or state B, we have to check. Are you all really with me? So, my dear lovable students, only 50% of income is covered by the provisions of the double taxation avoidance agreement. Remaining 50% are not covered. Why this example is this much important? Because for whom the DTA is applicable, number 1, resident of what state? Number 2, physically transparent entity. Physically transparent. Sir, in one country, one entity may be treated as transparent, but in other country, it may see it as opaque. Sir, income derived by, yes, interest has been derived by the firm which is situated in partnership firm situated in country B, or through a physically transparent entity under the tax law of either contracting state, to be considered the income of a resident of a what state? So that interest received by partnership firm will be treated as the income of the partnership firm, which is a resident of the contracting state. But to how much? To the extent such income is treated for the purpose of taxation by that state, sir, as the income of the resident of that state. In this case, only 50% of the income, that's what, to the extent. So, only to the extent of 50% of the income, provisions of double taxation avoidance agreement will be. For the remaining 50%, sir, provisions of DTA will not be applicable because it's not a person covered. Only to the extent of 50% person covered. So, for the extent of 50%, you can enjoy either tax credit method or tax exemption method as the. And the third category of people to whom the DTA is applicable is collective investment vehicle. Collective? Like REIT, my dear lovable students, REIT investment funds and all. We all studied that, sir, in order to apply the provisions of DTA, sir, that person should be resident of either contracting state or resident of both the contracting state, right? But sir, in a REIT, you cannot ensure that all the residents should be the resident, all the investors, unit holders should be the resident of that contracting state. But still, if that REIT has been, sir, set up in a contracting state, the provisions of DTA will be applicable to that what state? To that REIT. So, provision dealing with application of what model convention? To collective investment vehicle. What the UN model is saying, that not the OECD model, UN model is saying that if you are setting up a collective what vehicle? Investment vehicle. And if that collective investment vehicle has been set up in either of the what state? Contracting state, then provisions of DTA will be applicable to that REIT, collective investment vehicle. So for 3 people, one line summary of the entire discussion is, for 3 people, sir, the DTA will be applicable as per article number 1. Number 1, resident of the contracting state, physically transparent entity, and collective investment vehicle. Sir, now moving into the, sir, article number 2, taxes covered. What are the taxes? Sir, when they enter into DTA, they will say that these are the taxes covered. These are the taxes covered. That's what article number 2 is all about. Taxes on income and capital. Taxes on income and capital. Generally, article number 2 will explain that what are the, for what and all taxes this DTA will be applicable. Number 1, taxes on income and capital. Taxes on income means income tax. Taxes on income means income tax. Taxes on capital means wealth tax. Taxes on capital means taxes on income means income tax. Taxes on capital means and coverage of taxes. So many taxes we will impose and so many taxes we will include. So many taxes we will impose and so many taxes we will include. So taxes on income and capital, that is the first tax. So whenever 2 countries are entering into double taxation avoidance agreement, they will explicitly say in article number 2 that whether this DTA is going to cover taxes on income or taxes on capital or like that. Are you understanding? So the MCs, what is MC? Apply to taxes on income and on capital imposed on behalf of what state? Or of its political subdivisions or local authority, irrespective of the manner in which they are levied. So what are the taxes we are going to deal with, it will be explained in article number 2. Coverage of taxes, and in addition to taxes on income and capital, DTA will cover 2 things. Number 1, taxes imposed and taxes imposed. Taxes on income and capital cover, sir, taxes on what income? Total income. That's what income tax, based on total income you are paying certain tax. Taxes on what? Capital. That's what wealth tax. But in India now wealth tax has been abolished. India now wealth tax has been abolished. Sir, on elements of what or what? Income or capital. Let's look what included. Taxes included. Taxes on gain from alienation of movable or what property? By renting of movable or immovable property, you may get income from what property? House property. Even that income from house property will also be dealt in the double taxation. And taxes on total amount of wages, salaries paid by the enterprises. That means salary income will also be, sir, covered in the double taxation avoidance. And taxes on capital appreciation, which is nothing but what? Gain. So these type of taxes will be explained in article number 2. So when you take any DTA and if you see article number 2, you can understand what and all taxes has been discussed in the double taxation avoidance agreement. Those taxes can be classified into 2 categories. Number 1, taxes on what and what, and number 2, coverage of tax. That coverage of taxes classified into number 1, taxes imposed and taxes included. Comfortable, sir? Come to article number 4, residence, sir. What this residence is saying that, my dear lovable students, we understood that as per article number 1, in order to enjoy the benefit of double taxation avoidance agreement, you should be a resident of either country. Either you should be a resident of country A, or you should be a resident of country B, or you should be a resident of both the countries. Sir, what is the problem arises, you know, if they are resident of both the countries, my dear lovable students, hello, the certain income will be taxable based on the residence rule, whereas certain income will be taxable based on the source rule. Alright. So if they are resident of both the country, we have to take extra efforts and we have to fix that A, you are not resident of country A and you are resident of country B, or you are not resident of country B, you are resident of country A. So we have to take some additional steps. So first, what you are supposed to do is you make them resident, normally resident of one particular country, as based upon their domicile or based upon their residence or any other similar criteria or place of management or place of incorporation as per the domestic law. As per that, that means India is having Indian Income Tax Act, Pakistan is having Pakistan Income Tax Act. So as per Indian Income Tax Act, you make one person resident of India. So I check the domicile, I check the residence, 182 days condition in India, any other similar criteria, place of management or place of incorporation, I got that guy as resident of India. Fantastic. I'm very happy. Now for that guy, I checked, sir, the domicile, residence, any other similar criteria, and what? Place of management and place of incorporation as per the Pakistan what? Domestic law. There also he fall under the resident category. That means he is a resident in India as per the domestic law. He is a resident in Pakistan as per the domestic Pakistan law. Understanding? Now only relevance of rule number 4 will be applicable. Rule number 4 is tiebreaker rule. What breaker rule? Tiebreaker. What they are saying that this is the tiebreaker rule. What they are saying that we are going to break the tie. So you have to check whether that dual residentship person is an individual or other than individual. Whether that dual residentship person is an individual or if the dual residentship person is individual, my dear lovable students, you have to follow 5-step approach. You have to follow. Check whether he is having permanent home or whether is there any center of vital interest, habitual abode, nationality, and the map mutual agreement between competent authorities of the contracting state as per article number 25. We have to go and check, man. Article number 25 is talking about the map mutual agreement procedure. So if you are a resident of both the contracting state and if the assessee is an individual, follow how many step approach? That's what here part. Residential status of any person shall be determined as per the domestic tax law of that country. That's what the first step you are supposed to do. On what basis I will determine the residential status? It's based upon either domicile, residence, any other similar criteria, place of management or place of incorporation. Once you get the answer for that, if any person become resident of both the country, then his residential status shall be determined as follows. For individual, he shall be deemed to be resident of only of the state in which he is having permanent home available to him. Check in which country he is having permanent home. Either he may have permanent home in both the country or he may not have permanent home in both the country. Right? If he is having permanent home in both the country, don't go and check the square feet of both the houses and the house in which having more square feet will be treated as resident. Such rules and all not explained. If he is having permanent home available in both the states, he shall be deemed to be a resident, coming to the next point, of the state with which personal and economic relationships are closer. That is center of what interest? Vital interest. Okay, you are having, sir, homes in both the country, permanent home in both the country. Now check, sir, where you are doing business. Sir, I am doing 3 business in country A. I am doing 2 business in country B. That means your economic relation, personal and economic relations are more in country A. That means you are a resident of country A. Sir, where your entire family is staying? Country A. So, your personal and economic relationship example only business, personal relationship only family. Sir, I am having 3 business in country A and 3 business in country B. Then it is equally divided. So center of vital interest will also not applicable. I am coming to the third one. If the state in which he is having his center of vital interest cannot be determined, or if he has not permanent home available to him in either state, he shall be deemed to be a resident only of the state in which he is having what about? Habitual abode. Where you are habitually, where you are staying, habitually where you are spending your time, where you are doing business, habitually where you are spending more time in country. If he has a habitual abode in both the state or dash of them, neither of them, he shall be deemed to be a resident only of the state of which he is a national. Check in which country is the citizenship. National. Sir, I am having national of both the country. If he is national of both the country, both the states or neither of them, the competent authority of the contracting state shall settle the question by map. The competent authority of the contracting state will call and ask them, hey, come on, you gotta sit, come on. So the competent authority of India will call the competent authority of Pakistan and they will decide, they will put a toss saying that Tala vanda unakku, valu vanda enakku. And they will say that this guy relating to the India or this is what the 5-step approach. Step number 1, check the permanent home, center of vital interest, habitual about nationality, map between competent authority of the contracting state as per article number. Fantastic to the core. Now coming to the company. That means for persons other than individual. You tell me for persons other than individual, my dear lovable students. Is it possible for checking of home and all? Straight away step number 5. What is step number 5? Map. So residency shall be determined by competent authority by way of map. Having regard to its poem, place of effective management, place of incorporation, etc. That map will decide the things based upon poem. Map will decide the things based upon place of incorporation. They will see where they have incorporated the company, where their place of effective management is there. And after looking into all those things, the competent authority will take a decision. Shall I proceed? I am coming to the next article, article number 5, which is talking about what establishment. Sir, there are two models are there, OECD model and UN model. OECD model advocates the emphasis for what? Residence principle. Whereas UN model emphasis on source principle. For example, if you are having business profit will be taxable based on the dash principle, source principle or residence principle. Generally business profit, residence principle. Generally business profit will be taxed based on the residence principle. But the exception to the business profit, it will be taxed based on the source principle if you are able to establish the what establishment. Then only exception will work. Generally business profit will be taxed based on the residence principle. So article number 5.1 states the basic rule for a what establishment and expresses primarily meaning of the permanent establishment. Permanent establishment exists if the following conditions are satisfied cumulatively. If the 6 conditions are there, 6 conditions cumulatively satisfied, then you can say that there is a what establishment. Once if you prove that there is a permanent establishment, business profit will be taxed in the country of source and not in the country of. Fantastic to the core. So there is an enterprise. First there should be a such enterprise is carrying on what? Business. And there is a what of business? Such place of business is at the disposal of the what? Enterprise. Place of business should be fixed and business of the enterprise is carried on wholly or partially through this fixed place of. So if all the 6 conditions are cumulatively satisfied, that means there should be a enterprise. Such enterprise should carry on business. There should be a place of business. Such place of business should be at the disposal of the, and place of business should be, and business of enterprise is carried wholly or partly through this what place of business fixed. If all the 6 conditions has been, then we can say that there is permanent establishment. There is. Now article number 5.2 is saying that the term permanent establishment include especially a what of management. For example, some other state, some other contracting states place of management is there, then we can say that there is a what establishment. Or branch is there, we can say that there is a permanent establishment. Or office is there, we can say that there is a permanent establishment. Factory is there, then we can say that there is a permanent establishment. Workshop is there, then we can say that there is a permanent establishment. Mine, oil or gas well or quarry or any other place of extraction of natural resource is there, then we can say that there is a permanent establishment. So as per article number 5.2, sir, permanent establishment include a branch, a place of management, an office, a factory, a workshop, or a mine, or oil, gas, well, or quarry. Fantastic to the core. Now, OECD model tax convention. OECD. Sir, as per OECD model tax convention, a building site or construction or installation project constitutes a PE if it lasts for more than how much months? 12 months. That means, my dear lovable students, as per OECD, for example, I am from Pakistan, I am going to construct a building in India, I am going to install a project in India. If it lasts for more than how much months? 12 months, then we can say that there is what establishment. But this is not the view of UN model tax convention. UN always will have a relaxed mode. Because UN want to tax the things. Whereas OECD does not want to tax the things because OECD is between what countries? Developed countries. Developed countries. Whereas UN is between developed and that's what they are saying. UN model tax convention is wider as its cover assembly and what project? Installation and supervisory activities in connection thereto and require the activity in question to continue only for what?
6 months.
That means as per the UN model tax convention, no need to construct and all, no need to install and all. Even if you are engaged in assembling, even if you are engaged in installation project in India, which extend to more than 6 months, then itself we will declare that you are having a permanent establishment in India. That means UN want to cover those things as quick as possible. Are you all really with me? So we are having different types of permanent establishment. Number one is service PE, agency PE, insurance PE. Sir, UN model makes a specific reference to what PE? Which is absent in what model?
OECD.
So always who will be having addition? UN model. Who won't have addition? OECD model, because UN model is between developed and developing countries, whereas OECD already they are developed, so they are not worried about the service PE and all. What UN model is saying that the furnishing of services are if you are providing services, including what services? For example, after you become a chartered accountant, sir, in this November, you are going to Dubai and you are going to set up an office in Dubai. The same way, a person who are situated outside India is coming to India and they are providing consultancy services by an enterprise, either through their employees or other personnel engaged by the enterprise for such purpose. But only if the activity of nature continue within a contracting state for a period or period aggregating more than how many days? 183 days. So what UN is saying that, sir, the 183 divided by 365 or 366 as the case may be in a 12 months period commencing or ending in the fiscal year is concerned. That means what UN model is saying that with regard to service PE, if the service provider is coming from outside India to India and if they are providing that service more than continuously 183 days out of 365 days in a year, then we can say that that country, that concern is having a permanent establishment in India. Permanent establishment in India. Are you all really with me? Whereas in the absence of what PE? Service PE, OECD model, the presence has to be ascertained through general principle under article number what one? That means you have to check whether 6 conditions cumulatively and or not. If 6 conditions cumulatively satisfied, then there is a permanent establishment. Otherwise, there is no permanent. So this additional service PE is there only in where? UN model. Are you all really with me? It is not there in where? OECD model. Hello, sir. So here you look at it, sir. 12A, 12B, 12A, 12B. This 12A, 12B is not there in. Whereas fees for what services? Technical services. Income from automated digital services. Income from? These two things are available only in the. These two are service PE only. For these two things, they need service PE. But these two things are not there in OECD model. Actually, fees for technical services is service PE. Yes, sir. And income from automated digital services is again service PE. So, who need only service PE? That's why UN model explains service PE. Who did not explain? OECD model did not explain. Then, sir, where OECD model it will fall, sir? What is article number 7? Business profit. They don't say that, sir, profits and gains of business and profession both will fall under section NSR article number 7 itself. Are you all really with me? There business is separate for UN and service is separate for UN. That's why they kept separately what model? Service. What PE? Service PE. Comfortable, sir? So, in the absence of, that means in the OECD model, there is no what PE at all? Service PE at all. So, you have to calculate as per the general provision, normal provision as per article number N1. Now they are going to talk about the next type of PE called as what PE? Agency PE under the OECD model and the UN model. Agency PE under the OECD model and UN model target activity done by what agent? Of enterprises in the what state? For example, one entity is that they are situated outside India. Their agent is situated in India. and we are going to say that you are having a permanent establishment in India. That means if you are having a dependent agent, this is a recent update. The recent update expand the definition of what agent? Of dependent agent PE, which is dependent agent PE, to include instance when agent habitually conclude contract or habitually plays the principal role leading to conclusion of contract routinely concluded without material modification by that. That means on behalf of the enterprise which is situated outside India, one dependent agent is situated in India and he is materializing the contract, and that materialization is not revoked by the head office or the principal which is situated outside India, then we can say that that enterprise is having a permanent establishment in India. Because if there is permanent establishment, only business profit can be taxed in the source state. Otherwise, the business profit will be taxed in the resident state. That is a general principle, right? And the next one, article number 56, relating to what? Insurance fee. The next type of fee, insurance fee. So under model tax, UN model tax convention, as additional article 56 relating to what? Insurance, which is absent in the what model? So this insurance fee is not there in the OECD model. OECD is not pictured. OECD is between what country? So they don't have agency fee, they don't have what? Service fee, they don't have what? Insurance fee. Hello sir. Sir, UN model tax convention has additional article under 56 relating to insurance, which is absent in the what model? As per this article, insurance enterprise of a contracting state shall, except in regard to reinsurance, don't worry about reinsurance, put it on dustbin, be deemed to have PE in other contracting state if it collects premium in the territory of the other state or insurer is situated therein through a what? Person. That means insurance company is situated outside India and that insurance company is collecting premium from at least one person in India. That means as per UN model tax convention, we can say that they are having a permanent establishment in India. Whereas, sir, in the absence of similar article in where? A PE of an insurance enterprise has to be determined in accordance with article 5.1 or article 5.2 of the what model? They don't have such a stringent rules. Even 1% taken the insurance doesn't matter. My dear lovable students, you have to go and check whether 5.1 conditions has been satisfied or 5.2 conditions has been. So these are the different types of PE, permanent establishment. One is service PE, agency PE and insurance PE. Comfortable, sir? I'm coming to the next one, man. Article number 7 is talking about what profit? For business profit only we are talking about the what establishment? Business profit of an enterprise can only be taxed by the resident state. This is the common understanding. Generally, business profit can be taxed only by the resident state. Are you all really with me? Right of source state to tax business profit and enterprise only exists if a what exists? In its jurisdiction. That means if there is permanent establishment, then the source state can tax the business profit. Otherwise, always the business profit can be taxed by the fantastic to the core. As per OECD, what is OECD? Agreement between developed countries. Model tax convention. Once PE is proven, source state can tax only such profit as are attributable to the PE. UN model tax convention amplifies the attribution principle by a limited force of attraction. Wow, fantastic to the core. What is this? Is a brilliant, a beautiful line. You should understand in the way in which it has to be understood. There are two model tax conventions are there, OECD model tax convention and UN model. What OECD is saying that first you should understand the background, otherwise the discussion you will never understand. Business profit can only be taxed by the resident state. Business profit can only be taxed by the resident state. Why? For example, my name is A&M. I am starting A&M classes in Dubai. Whatever income I earn from that business in Dubai will not be taxed in Dubai, will be taxed in India. The reason or the logic is the person is the reason why business is standing. For example, A&M classes is there. Sir, because of A&M, sir, that tag, that name, business is standing. So, that person belongs to which resident country? If it's not there, business is not there. If it's not there, so business profit will be taxed in the country of the residence. For example, if I am a resident of India, I have to pay the tax to the Indian government, not to the. It is not because of Dubai that business is existing. It because of that person business is existing. Understanding? But what Dubai government is asking that, you are coming to Dubai, you are exploiting the natural resource of Dubai, you are using the natural resource of Dubai, you are doing business in Dubai, you are earning profit from Dubai, and you are taking the entire profit from Dubai to outside, and you are not even paying any tax to Dubai, means that is not ideal. So that's why they said that if you are having a permanent establishment, either as per 5.1 or 5.2, or as per agency PE or service PE or insurance PE, then you are liable to pay tax to what? Source country. Then residence principle will not be applicable, then source will be applicable. Now question arises. Now I ask the question to the Dubai that, hey Dubai, I am having 5 country, business in 5 country. Whether all the 5 countries profit I have to pay tax in Dubai, or only Dubai's profit I have to pay tax in Dubai. Are you understanding? That OECD explained very sir, happily, as per OECD model tax convention. Once dash is proven, so state can tax only such profit are attributable to the permanent establishment. Whatever profit attributable to that permanent establishment will be taxed in source country. You tell me, sir, wealthy person pichakara. They said that we are not happy if you pay tax only or attributable to the. That's what the UN model tax convention amplifies. Amplifier means which will increase the sound. So they increase the scope. Who increased the scope? UN. This attribution principle by limited force of attraction rule. They brought one rule called as limited force of. This is what force of attraction rule. Force of attraction rule implies that when a foreign enterprise set up a PE in a state of source, it brings itself within the fiscal jurisdiction of that state of source, to such a degree that profit that an enterprise derives from such source state, whether through the PE or not, can be taxed by the source state. Nothing understood, sir. I will give you a simple example to make you understand. Very simple example, my dear lovable students. For example, this is ANM Limited. And this is ANM Incorporation. This ANM Incorporation, assume they are situated in Mauritius. Assume they are situated in Mauritius. This ANM Limited is manufacturing. They are situated in India. They are manufacturing Mercedes-Benz. They are manufacturing Mercedes-Benz in India. Right. Sir, there is one company called as Tata. They are having Tata Motors. There is no doubt about it. But Tata wish to, sir, purchase 500 Mercedes-Benz. 500 Mercedes-Benz. Tata wish to purchase 500 Mercedes-Benz. Or instead of Tata, since they are having Tata Motors already, you can take some other company like any Indian company. Can we say Infosys? Is Infosys an Indian company? For the time being, yes, sir. So Infosys. Sir, Infosys want to purchase 500 Mercedes-Benz, which may be going to gift as a gift to the employees. Fine. So actually, this Infosys came to the showroom of ANM Limited, which is in India. They saw the Benz car. They talked about the price, deal, everything from the ANM Limited's office. And finally, they placed the order. Who placed the order? With the ANM Incorporation, Mauritius. They placed the order with the head office, not with the branch office. Are you all really with me? Now, what Indian government is saying that this is business profit. For business profit, once, sir, dash is finalized, PE is finalized, sir, dash rule will not be applicable. Residence link will not be applicable. Source link will be applicable. So as per the source link, sir, whatever profit earned by the Indian branch, you are liable to pay in India. But what OECD model is saying that only profit attributable to that particular branch will be taxable in India. That means, sir, total car sold by A&M branch is 2000. Only for this 2000 you have to pay tax in India. Whereas UN model is saying that no. This Infosys, why Infosys placed the order with A&M Incorporation? They are situated in Mauritius. It is because of the A&M Limited which is there in India. That means there is a what of attraction? Force of our Indian branch attracted the Infosys. Because of seeing the advertisement in the Indian branch only, they came to know about there is a brand called as Mercedes-Benz. Ideally, they should have agreed with the Indian branch, not with the Mauritius branch. So, even though the profit has been booked by the what branch? For that 500 cars, pay tax in India. We are not happy. We are not happy if you are paying the tax only to the extent of profit derived by that particular branch. Sir, whatever indirect benefit that particular branch is getting through dash of attraction, force of attraction, even for that also we need tax in India. This is a stand of Yarodede. Now you read it. As per OECD model tax convention, once the dash is proven, so state can tax only such profit are attributable to the what establishment. Whereas UN model tax convention amplifies this attribution. Amplifies means increases. Principle by a limited what of attraction rule. Even though it is a limited force of attraction, the profit attributable to the 500 car which has been booked by the Infosys with the head office which is A&M Incorporation, which they are situated in Mauritius, should be taxable in India. Are you all really with me? So FOA rule, what is FOA? Implies that when a foreign enterprise set up a PE in the state of source, who's the foreign enterprise as per our example? A&M Incorporation. They set up a branch in India called as what? A&M Limited. So India is a source country, right? It brings itself with its fiscal jurisdiction of that state, that is a state of source, to such a degree that to what degree the profit will be taxable is what explaining. That profit that the enterprise derive from what state? Source state, whether through the what or not? P or not. Sir, this profit they have not derived through this PE. Are you all really with me? 500 cars profit has not been derived through Indian PE, whereas 500 cars profit has been derived through the Mauritius PE. So even though that profit has been derived by what PE? Mauritius PE, can it be taxed by the what state? So even for the profit earned by the sale of that 500 car will be taxable in the source PE. It is because of limited force of attraction rule. Because of force of attraction only, the Infosys has purchased the car from the A&M Incorporation, which they are situated in Mauritius. Otherwise, why, sir, Infosys has to place their order with the Mauritius branch? Because they are situated in India. Even we are having a permanent establishment in India. To promote the sales in India only, we started a permanent establishment, right, in India. So if the A&M Incorporation got any business from India, means it is because of the limited force of attraction of the PE in India. So the profit attributable to those sales should be taxable in India, should not be taxable in Mauritius. Basically, what they have done is they have done a base erosion and profit shifting. Instead of booking the sales in India, they book the sales in Mauritius, because Mauritius is a tax and India is a tax. So as per Article 7 of the UN Model Tax Convention, if the enterprise carries on business in the other contracting state through a PE, profit of the enterprise may be taxed in the other state, but only attributable to what PE? That PE. That PE including limited force of attraction rules. What the Indian UN model is saying that We are not asking the total sales made, which is 5,000 lakh cars sold by A&M Incorporation at Mauritius. On that we are not asking the profit. That we know that is injustice. We are not asking you to pay the entire tax on India. But this 500 car has been sold because of the limited force of attraction of our PE. That should be taxed in India. That's what the next one, that PE. Or sales in the other state of goods or merchandise of the same or similar kind as those sold through that PE. Or other business activity carried on in that other state of the same or similar kind as those affected through that PE. Sir, our sales that PE is making, foreign PE is making, that means that will be taxed in India. Our services, our business activity, who is carrying? Foreign Mauritius, sir, PE is doing, then it is, that is what law of force of attraction. That is our sales, correct? So, whatever real sales made at our PE will be taxed in India. Whatever sales in the what state? Of goods or merchandise of the same or similar kind as those sold through that PE. Actually, that 500 cars should be sold through Indian PE, but they sold through even though that 500 cars has not been sold through the Indian PE, it will be treated as if it's sold through the. And any other what activity? For example, after selling that car, they are providing services. After sale services. That is any other business activity carried on in that what state? Of the same or similar kind as though affected through that PE, those items will be taxable in India because of limited force of attraction of law. Comfortable, sir? That's it with regard to what profit, man? Business profit. What is article number 1? What is article number 2? What is article number 3? Definitions, leave it. Article number 4, residence. Article number 5, article number 7. The next slot what we are supposed to discuss after 10-15 minutes break is IFRS. What it is? IFRS. We are going to talk about interest under article number 11. Where to tax the interest? Sir, royalty. Where to tax the royalty? Fees for technical services. Where to tax the fees for technical services? This I am calling it as what RS? This is part number 2. Part number 2. Business profit will always taxable where? Residence. But if you are able to prove the what establishment, then resident link will not be applicable. Source link will be applicable. The exception for this discussion, whatever we discussed till now is IFRS. Is even though there is no what establishment, IFRS will always taxable in the source country. That means without what establishment, permanent establishment, IFRS will be taxed in the source country. Because in order to do a business, you should have a permanent establishment. But in order to get the interest, why you need a permanent establishment? Just pump the capital from outside India to India. And Indian people are paying IFRS. So from where you are getting revenue? India. Pay the tax to the government of India. There if you are keeping residence rule, no tax will come to Indian government. Correct? So for IFRS, don't check the permanent establishment criteria. It is an exception to permanent establishment, which are as IFRS. That's what article number 11, interest. Article number 12, royalty. Article number 12A, fees for technical services. Fees for technical services. Article number 11, what is 11? Interest. Article number 11, interest. Interest. Article number 12 is what? Royalty. Article number 12 is what? Royalty. Look at this, royalty. 12, sir, 12, royalty. R stands for royalty. That's why article number 12 is royalty. It is 1, 2. Yes, sir. That's why article number 12 is royalty. Article number 12A is fees for what services? Technical services. Fees for technical services. So this IFRS is what our next slot of discussion. Before that, take a discussion of 10 minutes. Till now, I spot article number 1 is talking about persons covered. Article number 2, taxes covered. Article number 4, residence. Article number 5, permanent establishment. Article number 7. So this is one set, my dear lovable students. So business profit is generally taxed in the country of residence. But it is having an exception saying that if you are having a permanent establishment, then business profit will be taxable in the state of source. That's what we have studied. We are going to talk about the interest. Article number 11, interest. Right of contracting state to tax interest. First, we are going to see which contracting state is having the right to tax the interest. Whether the state of residence or state of source. Para number 1 is saying confer the right to resident state to tax the interest. So para number 1 is talking about confer the right to dash state. Resident state. That means even IFRS is also generally to the resident state. Now UN model tax convention is asking if everything if you are giving to resident state, then for what I am here? You should give to me also. Don't give everything to the resident state. If everything to resident state, that you say with the OECD model. Don't say with the I want in the N state. So para number 2 has been introduced. Confer right to the source state to tax the interest. So para number 2 is saying that AUN, don't cry. We are giving the right to tax the interest income even to the what state also. Generally, interest is taxed in the what state? At a given rate on what basis? Gross basis. For example, 115A, non-resident, source is from India to a non-resident, will be taxing the normal interest at the rate of 20%. What percentage? 20%. So as per para number 2, generally, actually para number 1 is a apple, which is saying that even a resident state can also tax the interest income. Para number 2 is saying that source state can tax the interest income. Generally, interest means it will be taxable only in the what state? Source state. That too based on gross basis. That too based on gross basis. That's why PGBP deduction will not be available. IFRS deduction will not be available. Chapter 6A will not be available. Chapter 6 will be available. Proviso 1 to section 48 will not be available. Proviso 2 to. These are the 6 rules of non-resident taxation. Comfortable. So generally interest is taxed in the source state at the given rate on gross basis. However, if the beneficial owner of the interest is the resident of the other contracting state, then the tax so charged should be less than or equal to specified percentage on what interest. But if the beneficial owner is situated in the other contracting state, not the state in which the sources are coming, then what the model is saying that you have to charge the interest at some percentage. The specified percentage as per the OECD model convention is how much percent? 10%. OECD is saying that to the source state you give 10%. We are happy. But under the UN model tax convention, least this percentage to be established through what negotiation? UN is saying that it is you have to sit and talk whether it is 10 or 15 or 20%. So my dear lovable students, India will be having OECD model tax convention or UN model tax convention. So 115A general interest will be taxable at 20%. So Income Tax Act they put 20%. If they want to reduce, they will sit and talk with the double taxation avoidance agreement and they will take a rate which is less than 20%. 10 to 20%. Definition of interest in what and what? Interest means income from debt, debenture. From debenture, whatever you are getting is called as interest. Claim of every kind, whether or not secured by what? Or whether or not carrying a right to participate in the what profit. This is what the definition of interest. Sir, specific inclusion in the definition of interest as per OECD and income from what security? From government security, if you are getting any income, that is also interest. Income from bonds or debenture, that is also premium and price attaching to such security bond or debentures, that is also, but interest does not include penalty charges for what payment? That is penalty only, that is not interest. For that, this article will not be applicable. Other income article will be applicable for the penalty. Are you all really with me? With this backdrop, we will read what is there in our material. Paragraph 1 provides the right to resident state to tax the interest. Kandipa. Paragraph 1 of article number 11 is saying that on interest, which country is having the right? Para 2, however, also confer right to the source state to tax the interest. Always later the better. So para 1 is saying that generally interest will be taxed in the state of residence. Whereas para 2 is saying that, but if you want, when you are entering into double taxation avoidance agreement, instead of residence state, you can keep in what state also? Generally interest is taxed in the what state? At a given rate on what basis? However, if the beneficial owner of the interest is a resident of the other contracting state, the tax so charged cannot exceed a what percentage of the gross amount of the interest. If the person who invested the amount is the beneficial owner, person who was spending that money is of the other contracting state, then you should not charge in the source state. When you are taxing, don't charge beyond a particular percentage. Beyond a percentage. That percentage has been expressly said by what model? OECD model. But no percentage has been expressly said by OECD model. Specified the percentage as, but the UN model leaves this percentage to be established through bilateral negotiation, because who's wealthy? OECD said that if we are getting 10%, that we are happy. Whereas UN, they are trying their level best to push more than 10%. So you come, we will sit and talk. Are you all really with me? Definition of interest. It may be noted that definition of interest in both the model is similar. It means income from debt claim of every kind, whether or not secured by mortgage, and whether or not carrying a right to participate in the debtor's profit, and in particular what from government. So there is no specific difference of definition of interest in what and what? OECD and both are same. Securities and income from bonds or debentures, including premium and prices attaching to such security bonds or debentures. Penalty charges for late payment are not regarded as interest for the purpose of this article. So the definition of interest under both OECD model and are one and the same. So what are the takeaway of article number 11? Sir, article number 11 is having lot of paragraphs. Para 1 is saying that the resident state is having the right to tax the interest. If you don't want resident state to tax the interest, para number 2 is saying that no problem. So there is a confusion, sir. Para 1 and para number 2, they themselves are creating confusion. That's why next para is saying that generally source state is having the right to tax the interest. So that's what we have to take. Generally source state is having the right to tax the interest. But if the beneficial owner of that interest is not in this contracting state, that is a source state, if they are in the resident state, when you are taxing interest, when the other country is taxing interest, it should not go beyond a particular percentage. OECD said that we need only 10%. UN said that come and talk, we will sit and discuss. Now we will not say anything, we will sit and negotiate. Are you all really with me? There is no specific difference of meaning of interest between OECD and both are having the same, but only one thing both are saying is penalty charges for late payment will not be regarded as interest for the purpose of. Fantastic to the core. That's it, sir. Coming to, sir, article number 12, ROI. What is ROI? Royalties. We are having OECD model, UN model. Right of contracting state to tax royalty income is the first discussion. OECD means wealthy pichakara. ROI arising in what state? And beneficially owned by resident of the what state is taxable only in the resident state. Only in the. Thus, resident state have exclusive tax, exclusive right to tax the what income. OECD is saying that this royalty has been accrued or arisen because of the person of our residence. So the brain is our residence. So the tax should come to the residence, because if he is not there, he will not find out anything. If he has not find out anything, royalty will not come. So we are not ready to provide the royalty to the source state. Interest okay, because interests are, even a beggar can put FD with some other country, and the other country, source country, can give interest. To earn the interest, sir, brain is not required. But to earn the royalty, brain is required. Where the brain is situated? Resident country. So for royalty, as per OECD model, they are saying that we are not ready to provide you the tax to the what country? Source country. There is no option and all. There is no paragraph and all. It can be only be taxed in. Are you all ready with me? Anyway, we all know that this will not be allowed by. ROI may also be taxed in the source state. As per what model? However, if the beneficial owner is a resident of the tax charged by the source state should be either less than or equal to the specified percentage to be established through what negotiation of what royalty? Gross royalty. Fantastic to the core. But UN model is saying that, no, like that you don't say. Why are you saying like that? We, source country, should also have the what? Right. As for the what model? UN model. India is entering only in UN model. So all UN model are based on source state only, except the business profit. There, if permanent establishment is there, India gone. John, you are gone. Correct? Yes, India will try to establish the what establishment? In India. That's why they tried their level best. 6 conditions they put as per 5.1. If any business organization or enterprise is not falling in that 6 condition, they said that branch, office, workshop, factory, all the stuffs will also be treated as permanent establishment. They slept. Next day morning they wake up. So many people are still not covering in the what establishment? Permanent establishment. They said that, are you a contractor? Are you in India for more than 12 months? Yes, sir. You are a permanent establishment as per OECD model. Then they copied. Okay, more than 6 months. Sir, you are having a permanent establishment. Are you an insurance company? 1% taken insurance in India? Permanent establishment. Your agent is situated in India? Permanent establishment. Services, sir. More than 183 days you are providing service in India? Permanent establishment. Anyone who was not covered in this category? Permanent establishment. So India tried their level best to, sir, make them as what establishment? Because if they NSR fall under what establishment? Permanent establishment, then only business profit will be taxed in the source country. Right. Anyway, from India, no one is going to invest outside India having permanent establishment at all. Don't worry at all. If they go and tax there, don't worry. Sir, global income is taxable in India. We will make it taxed. Correct? And with those countries, no, we will enter into double taxation avoidance agreement, either tax exemption method or tax. There you pay tax and come. We are ready to provide you the credit. You take foreign tax credit. Okay, fine, fantastic. Now, what is the definition of ROI? As for OECD, definition of ROI does not include A. They are royal family. Who? OECD. OECD are royal family. Both are. They said that these two are not what? Rentals for film or tape used for radio, TV broadcasting and all. These and all don't call it as ROI. ROI means according to us there should be brain. You should use the brain, and from that brain you should have the ROI. This is what? Rentals of film tapes. Film tapes, if you are giving for rental, that is normal other income only, not ROI income. And rental for industrial, commercial or what equipment? If you are renting equipment, what is the brain for the renting of equipment? Any person can rent that. Whereas who? Everything should be ROI only, man. Rental for film or tape used for radio or TV broadcasting should be treated as ROI. And what? Sir, equipment rentals like rental for industrial, commercial and scientific equipment should be treated as ROI. That's why. So everything is ROI. ROI. Are you getting rental from film tapes? Yes, ROI. Sir, are you getting rentals from equipments? ROI. Because once it become what only? ROI only, as per UN model tax convention, source country. So a non-resident is renting film or tape. That too you know, in India, how much importance for the film. Correct? So if the non-resident is what? Renting film or tapes. And if they are getting the rental income from India, we will treat it as ROI. Because if it is treated as ROI only, source country will be having the right to tax it. So India got the right to tax it. In India, no. 50% sir, of the people like film, 50% of the people like sports. Correct. Next one, scientific equipment. Rentals for industrial, commercial or what equipment? Scientific equipment. If you are getting any income, that will be treated as ROI. Now, that's what ROI. As per OECD model, ROI arising in what state? And beneficially owned by resident state are taxable only in what state? So, as per OECD, ROI will only be taxed in. Hence, the UN model departs from the principle of exclusive right to tax provided to resident state in the OECD model, right? UN will say that no, we want source. That's under the what model? The source state may also tax what? However, if the beneficial owner of a resident of the resident state, tax charged by the source state cannot exceed the specified percentage of the gross amount of. However, the UN model provides that royalty may be taxed in the what state? Resident state. Sir, sorry, this is mistake. This is what state? Source state. Definition of royalty under OECD does not include this rental from film or tapes used for radio or television broadcasting and equipment rental like rental of industrial, commercial or scientific equipment. But these two things will also be treated as ROI in the what model? Fantastic to the core. The next one, sir. 12A, fees for what services? What is Article 11? Interest. What is Article 12? ROI. What is Article 12A? The UN Model Convention as a specific article pertaining to fees for what services? Technical service. That means this is not there in. That's why one Kumbu 12A. If both are there, common number would have come. Whole number would have come. 12A. Because this is only there in. There is no specific reference to FTS in OECD Model Convention. Right of contracting state to tax, sir, FTS as per UN model. You tell me. What? Confer right to the resident state to tax the FTS. As per the UN model is saying that, yes sir, who can tax the FTS? Resident state. Don't finalize, wait, full stop. However, does not state that FTS is exclusively taxable in resident state. So it is not only taxable in. Establish the right of the what state? To tax the FTS in accordance with the what law? Subject to limitation on the maximum rate of tax on an amount of fee. To be established through bilateral negotiation if the beneficial owner is a resident of the what state? Initially they said that resident state can tax the FTS. But very next line they said that source state also can. So during the discussion time, they will say that generally FTS is to be taxed in resident state. But during the finalization of DTA, India will say that we want the tax on source state. But we will not tax more than certain percentage. That is our Nyayam Dharmam. Right. What do you mean by FTS? FTS means payment for managerial technical consultancy service, this is FTS. But exclusion from the meaning of FTS, these and all are not. FTS. Payment to a? Because you are having separate article 15 is there. Article that you don't take it as FTS. Payment for teaching in any education institution, you are having separate article is there, article 20. Article 20, students. In that article, if you see article already we read the morning, article 20 is what? Students. And article 15 is what? Income from employment, employee. So for that and all specific articles are there. Hello? Payment by an individual for service for what use? Personal use. No specific other income. Other incomes are there. So that will not fall under what? FTS, my dear lovable students. FTS. So here what they are saying with the 12A. In 2017, UN model has inserted a specific article pertaining to. There is no specific reference to FTS in the what model? Paragraph 1 provides that FTS may be taxed in the what state? But does not provide the FTS is exclusively taxed in the. It's not like the ROI of the OECD model. ROI of the OECD model is saying that ROI of the OECD will taxable only in. It's not like that. Paragraph 2 establish the right of country in which FTS arises to tax in accordance with its what law? Subject to limitation of the maximum rate of tax if the beneficial owner is a resident of the other. The maximum rate of tax is to be established through what negotiation? So what is Article 11? Interest. What is Article 12? ROI. What is Article 12A? Fees for technical services. We will be completing with this Article 12B, man. Income from automated digital services. Income from? Automated digital services. Sir, Article 12B was added to the dash model. That means even this is also not there in the. That's why 12B. It's not whole number. So 12A and 12B are only there in UN model. It is not there in its 2021 update to preserve the domestic law taxing right for state from which the payment for automated digital service are made. There is no such article in OECD model corresponding to article number 12B. So specific article they bought income from automated digital services. Automated? Have you heard about OIDAR? Online information data access or retrieval services. Right? So right of contracting state to tax income from automated digital UN model. As for UN model, where they will keep? Initially they may say that resident and all, but full stop and they will say that however. So confer right of the what state? To tax the income from automated digital service arising in a contracting state. However, does not state the FTS is exclusively taxable in the resident state. If they don't have this line, they won't put any clause. In order to tax that in the state only, UN model is having all these extra things. Correct? So then why they are saying, even resident state also, then only the other country will be ready to enter into double taxation avoidance agreement. During negotiation, they will say that, sir, have you read the next line, sir? However, yes, sir. So it establishes the right of what state? To tax the income from automated what services? In accordance with its what law? Subject to specified percentage of the gross amount of the paying underlying the income from the automated to be established through bilateral negotiation. If the beneficial owner is a resident of the other, that means you have to sit and finalize. Same only. Meaning of automated digital services as per UN model. What is the definition of automated digital services as per OECD model? Not there. It is there only in. So automated digital services, sir, it means any service provided on the internet or other electronic network in either case require minimal human involvement from the what provider. Because it should be automated. That's what online information data access and specific inclusion are online advertisement services, supply of user data, online search engine, online intermediation platform services, social media platform, digital content services, online gaming, cloud computing services, standardized online teaching services. If these and all provided by a person who are situated outside India to a person in India, then this is, and if we are making any payment, this is called as income from automated digital services. As per 12B of the article in the UN model, it is saying that, sir, generally resident state is having the right, whereas however so state can tax it by sitting and they will derive a certain percentage after the negotiation. This is what with regard to the what RS? IFRS. I stands for? As per article number 11. F stands for fees for technical services as per article number 12A. R stands for ROI as per article number, and the last S stands for income from automated digital services. What services you provided? Automated digital services. Automated. S means services. What services? Automated digital. Generally, if you look this family, IFRS, this IFRS does not have any connection with permanent establishment. Nowhere they said anything about the what establishment. Business profit is only having connection with the permanent establishment. IFRS is not having connection with the permanent establishment. Are you all really with me? Since IFRS does not have connected with permanent establishment, this will be taxable in the source country. This will be taxable in the source country. Whereas, sir, OECD is having difference of opinion with regard to interest resident state. Sir, OECD always will follow the resident state, whereas UN model will always follow the source state. Are you all really with me? Sir, if you see the ICAI study material, my dear lovable students, what type of question we can expect in examination from this? These are past examination question. Explain briefly the significant difference between UN and OECD model tax convention. OECD model tax convention is between two, whereas UN model tax convention is between two. OECD model tax convention is emphasis on resident principle, and UN model tax convention is comfortable. Fantastic, sir. And you can read the answer. Look at it. Everyone read it. OECD model is essentially a model treaty between two developed nations, whereas UN model is a model convention between a developed country and a further. OECD model advocates the resident principle. That is, it lays emphasis on the right of the state of residents to tax the income, whereas UN model is a compromise between source principle and giving more weight to the source principle as against the resident principle. That's it, man. Two differences. We are done, man. 4 to 5 marks. It will be in your pocket. When does it become necessary to apply the tiebreaker rule? When one person becomes the resident of both the country, we have to apply tiebreaker as per article number 4. Discuss the manner of application of the what breaker rule. You have to check whether he is an individual or individual 5-step approach, other than individual 5th step approach, which is MAP. Right. Shall we read it? Every jurisdiction in its domestic tax law prescribe the mechanism to determine residential tax status of a. First, you have to make one particular person as a residential status. If a person is considered to be resident of both the contracting state, relief should be sought from article number 4 of the what treaty. A series of tiebreaker rules are provided in para 2 of article 4 of model convention to determine single state of residence for an individual. Tiebreaker rule would be applied in the following manner. The first test is based on whether the individual is having a permanent home, would mean a dwelling place available to him all times continuously and not occasionally, and includes place taken on rent for a prolonged what of time. If that test is inconclusive for the reason that individual has permanent home available to him either both the contracting state, he will be considered as resident of the contracting state where his personal and economic relationship are closer. In other words, place where he lies is center of vital interest. Thus, preference is given to family and what relationship? Occupation, place of business, place of administration of his property, political, cultural and other activity of the. Para 2 establishes secondary criteria for two quite distinct and different situations. The case where individual has permanent home available to him in both the contracting state, or it is not possible determining which one is as is central of what interest. Case where the individual has permanent home available to him neither what state. In the aforesaid scenario, preference is given to contracting state where the individual has habitual abode. If the individual has habitual abode in both contracting state or neither of them, he shall treat as resident of the contracting state of which he is a. If the individual is of national of both or neither of the contracting state, the matter is left to be considered by what authority? Of the respective contracting state. Look at the question. When does it become to apply the what breaker rule? The answer is incomplete. They have not talked anything about other than individual. The answer talked only about what? Individual, and they move to the next question. Sir, when we write the answer, we have to write for other than individual. The map is the solution. Explain the meaning of interest and fees for technical services under the UN model convention. This is how they are asking the question. There is no difference or definition of difference in interest between OECD and UN. Interest means any income received from the debtor in the form of, sir, like that we read, that you have to reproduce, and does not include all those penalty. Yes, sir. And fees for technical services. So directly they are asking, what is the meaning of automated digital services? 12B, services, automated digital services. Online advertisement, online, all those. Cloud computing, online advertisement, supply of user data, online search engine, online intermediation platform services, social media platform, digital content services, online gaming, cloud computing service, and standardized online teaching services. That you have to take in your heart. What are the payments covered with the scope? royalty under UN model convention of OECD model convention. UN model convention, royalty includes payment for film and renting of the tapes and also the equipment. The term royalty as per UN model convention means payment of any kind received as consideration for use of right to use any copyright of the literary article, scientific work including cinematographic film or tapes used for radio or television broadcasting. And sir, does not include, but as per the OECD model, this has not been included. You know, these are the 5 question, book back question they asked with the overview of model tax convention. But still, we have to do one more slot to complete this, which is what gain? Capital gain, independent personal services. Are you really with me? Then we have to talk about other income, the balance income, and 23 and 23B, elimination of double taxation, and the map and the exchange of information. That means in one more class, my dear lovable students, we'll be talking about the others, because those are past examination question. From this area, if any question, what you will do? From any of this article also question can be asked. So 45 minutes to 1 hour, we'll be completing this article. With that, we can say that, sir, model tax convention comes to an end. I'm with you from your heart. Anybody